What happens when the Federal Reserve decides to lower interest rates? Interest rate changes by the Federal Reserve impacts nearly every corner of the economy. They influence how much consumers and businesses pay to borrow, the returns on savings, and even the value of the dollar on the global stage. This video discusses the ripple effects of the Federal Reserve's decision to lower rates, focusing on 18 key outcomes. By understanding these effects, you can see how monetary policy shapes the financial landscape and influences everyday life. Increased borrowing by consumers. When interest rates go down, loans become more affordable for consumers. This often leads to an uptick in borrowing for significant purchases like homes, cars, and education. For example, a lower interest rate on a mortgage can make monthly payments cheaper, encouraging more people to buy homes. This increase in borrowing supports economic growth, as consumers spend more and stimulate demand in various industries. Lower interest rates also make it easier for households to refinance existing loans, freeing up cash for other uses. Increased borrowing by businesses. Businesses also take advantage of lower rates to finance their operations or expansions. With reduced borrowing costs, companies are more likely to take out loans to invest in equipment, hire employees, or launch new projects. This can lead to job creation and economic growth as businesses expand their activities. For instance, a manufacturing company might upgrade its machinery, boosting production and efficiency. Such investments often ripple across supply chains, benefiting related industries and workers. Boost in housing market activity. A significant impact of lower interest rates is often seen in the housing market. Mortgage rates typically fall when the Federal Reserve cuts rates, making homeownership more affordable. This can lead to an increase in home purchases as well as refinancing activity, where existing homeowners secure lower monthly payments. The construction industry also benefits as demand for new homes grows. This sector's growth supports jobs in construction, real estate, and home improvement industries. Higher stock market performance. The stock market often reacts positively to lower interest rates. When borrowing costs decrease, businesses can operate more efficiently and report higher profits, which boosts their stock prices. Investors may also shift their money into stocks to seek better returns, as the yields on savings accounts and bonds become less attractive. This influx of investment can lead to a rally in the stock market, benefiting shareholders and boosting overall confidence in the economy. A stronger stock market can also encourage consumer spending through the wealth effect, as individuals feel more financially secure. Lower savings rates for consumers. While borrowers benefit from lower rates, savers often face reduced returns on their deposits. Banks typically lower the interest rates offered on savings accounts, certificates of deposit, and money market funds when the Federal Reserve cuts rates. This can discourage saving and prompt individuals to look for higher yield investments. For people relying on interest income, such as retirees, this decline can be challenging and may require adjustments to financial plans. The shift also reflects a broader emphasis on spending rather than saving during periods of low interest rates. Increased consumer spending. With borrowing costs reduced and savings earning less, people tend to spend more. Lower interest rates make it easier to afford big purchases like cars or appliances, boosting retail sales. This surge in spending supports businesses and contributes to economic growth by increasing demand for goods and services. Consumer spending is a critical driver of the economy, accounting for a significant portion of GDP. As people feel more confident about their financial situations, they are more likely to make discretionary purchases, further fueling economic activity. Decline in bond yields. When interest rates are reduced, bond yields often decrease as well. This is because newly issued bonds offer lower interest payments, aligning with the prevailing rates. As a result, the market value of existing bonds with higher yields tends to rise, benefiting current bondholders. Investors seeking steady income may find it challenging to secure attractive returns during such periods. This adjustment in yields can lead to a shift in investment preferences, with some opting for higher risk assets to achieve better returns. Depreciation of the US dollar. Lower interest rates can make the dollar less appealing to international investors, leading to a drop in its value relative to other currencies. This depreciation occurs because lower rates reduce the returns on dollar-denominated investments, prompting investors to seek alternatives. A weaker dollar benefits American exporters as their goods become more competitively priced in global markets. This change also makes foreign travel and imported goods more expensive for U.S. consumers. The overall effect can enhance trade balances, but may put pressure on domestic prices. Rise in exports. With a weaker dollar, U.S. exports tend to increase as they become more affordable for buyers abroad. This boost in competitiveness supports industries such as manufacturing, agriculture, and technology. Increased export activity can lead to higher production levels and job creation within these sectors. At the same time, stronger demand for U.S. goods helps balance trade relationships with other countries. Export growth is an important driver of economic expansion, particularly in times of sluggish domestic activity. Before we continue with the video, take a quick moment to hit that like button and subscribe if you haven't yet. And don't forget to ring the bell for notifications so you never miss out on our latest updates. Plus, we've got some helpful resources in the description. Check them out and share your comments after you're done watching. Cheaper imports for foreign economies. The decline in the dollar's value makes U.S. goods more affordable for consumers and businesses in other countries. This creates opportunities for foreign economies to benefit from cost-effective imports, particularly in essential categories like machinery, technology, and food. Increased demand for U.S. products abroad can strengthen global trade connections. This dynamic often leads to more robust economic ties between trading partners. While benefiting foreign buyers, this can also place upward pressure on production within the United States to meet higher demand. Possible increase in inflation. As borrowing becomes more affordable and consumer spending rises, demand for goods and services can outpace supply, leading to higher prices. This increase in inflation is closely monitored by the Federal Reserve to ensure it does not spiral out of control. While moderate inflation is a sign of a healthy economy, excessive price growth can strain household budgets and disrupt economic stability. Businesses may also face higher costs for materials and labor, which they may pass on to consumers. Managing inflation is a key consideration in any interest rate decision. Lower unemployment rates. Rate cuts are often followed by improvements in the job market as businesses expand and hire more workers. Lower borrowing costs enable companies to invest in growth initiatives that create employment opportunities. Industries such as construction, retail, and manufacturing are particularly responsive to these changes, as increased demand drives the need for more labor. This rise in employment contributes to higher household incomes, further stimulating the economy. As job creation accelerates, it helps reduce unemployment rates and supports overall economic health. Potential for asset bubbles. When interest rates are low for an extended period, asset prices can rise rapidly as cheap borrowing fuels demand. This can lead to inflated values in markets such as real estate, stocks, or commodities. While rising prices may benefit investors in the short term, they also increase the risk of a bubble forming, which could eventually burst and cause economic disruption. Policymakers are mindful of this risk and aim to strike a balance between supporting growth and avoiding excessive speculation. The impact of such bubbles can be widespread and long-lasting. Challenges for retirees and fixed-income investors. Lower rates reduce returns on fixed-income investments like bonds and annuities, posing challenges for those who rely on these instruments for income. Retirees in particular may face difficulties maintaining their financial stability in a low-interest rate environment. This situation often prompts a reassessment of investment strategies, with some choosing to allocate funds to higher-risk options. The broader effect of lower fixed income yields highlights the trade-offs inherent in rate adjustments. For savers, this environment can require careful planning to achieve long-term goals. Stimulus for emerging markets. When rates in the U.S. decrease, capital often flows into emerging markets as investors seek higher returns. This inflow of funds can support economic growth in countries with developing economies by providing access to capital for infrastructure projects and business investments. These markets may experience stronger currencies, rising stock prices, and improved economic activity. While beneficial, This shift can also create challenges, such as increased vulnerability to changes in global financial conditions. For emerging economies, these capital inflows represent both opportunities and risks. Pressure on financial institutions. Banks and other financial institutions can face tighter profit margins when interest rates fall. The difference between the rates they charge borrowers and the rates they pay depositors narrows, which can limit earnings. Smaller banks that rely heavily on traditional lending activities are often the most affected. This pressure can lead to cost-cutting measures or shifts in business models to maintain profitability. While beneficial for borrowers, sustained low rates can challenge the stability of the financial sector. Potential reduction in federal deficit costs. Lower interest rates reduce the cost of servicing government debt, easing pressure on federal budgets. This allows more flexibility in allocating funds to other priorities, such as infrastructure, healthcare, or education. Reduced borrowing costs can also lessen the immediate impact of rising national debt levels. While beneficial in the short term, policymakers must remain vigilant about long-term fiscal sustainability. Interest rate decisions often reflect a balance between supporting economic growth and managing public finances. Increased risk of prolonged low rates. Keeping interest rates low for an extended period can have unintended consequences, such as reducing the central bank's ability to respond to future crises. Over time, prolonged low rates may distort economic behavior, leading to overborrowing or misallocation of resources. This environment can also weaken the effectiveness of traditional monetary policy tools. Policymakers carefully weigh the benefits of rate cuts against these potential drawbacks. Ensuring economic stability while maintaining flexibility for future action is a critical goal of monetary policy. The broader impact of lower rates. Lower interest rates set off a chain reaction across the economy, influencing borrowing, spending, investing, and global trade. While they stimulate growth and provide relief to borrowers, they also bring challenges, such as reduced savings returns and the potential for inflation or asset bubbles. These decisions reflect the Federal Reserve's effort to balance economic growth with financial stability. Understanding the wide-reaching effects of rate cuts helps individuals and businesses adapt to changing economic conditions. As rates shift, their impact continues to shape financial landscapes and economic opportunities. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.